While the large cap component of a multi-cap fund can provide investors protection against the volatility that is likely in the equity markets in the near term, the mid and small cap component could fetch them the upside that is equally likely over the medium to long term. These were views expressed to us by Mr. Bhattacharya, Chief Investment Officer-Equities at Edelweiss Mutual Fund. In this interview with Business Standard, Mr. Bhattacharya also said that investors who have booked profits in the mid and small cap component of the market should also consider investing in a multi-cap fund for more diversified exposure. Do watch this interview to learn more about the role that a multi-cap fund can play in your portfolio. Good afternoon, Mr. Bhattacharya. It's a pleasure to have you on our show.
Very good afternoon. Thanks for inviting me to your show.
So we are speaking on the occasion of the launch of Edelweiss Mutual Fund's multi-cap fund. But I would like to begin by asking you a question about equities in general. The Israel-Hamas war is raging. Oil prices are moving up. Only recently, the US 10-year GSEC touched a high. So when investors, and especially new investors in our markets, hear all this negative news, they do get worried. In your view, why is this a good time to be invested in equities?
Great question to start with. I would say that, clearly, as you summarize, the global macro is looking negative. Likewise, if you look at local macro conditions, also we are likely to see volatility going forward as we see elections coming through by middle of next year. So in these, so that's the near term for you, maybe in the next 6 to 12 months. But if you look beyond that, then by middle of next year we'll have a stable government. We'll basically, while the globe is seeing weakness and geopolitical conflict right now, we will most likely normalize after that. And not only that, we will probably have a rebound in the various economies, sometimes maybe post middle of next year. So net, while the near term, the next 6 to 12 months looks a little muddled, the subsequent 3 or 4 years, actually, for India as well as for the globe, looks pretty robust. So how do we invest in these circumstances? So we have to sort of balance for the volatile negative near term, and at the same time make sure that we don't miss the medium term upside, which is why when we thought about this construct of the issue, we thought a multi-cap fund is ideally suited for these circumstances. So on one hand, you have the large cap exposure of about 40% or so, which kind of, to a certain extent nullifies or lowers the volatility in the portfolio. On the other side, 60% of the portfolio comprises of mid and small cap names, which can play quite well from a medium-term upside standpoint. So that's how we are looking at it from an investment standpoint. And hence, as you said, we are talking on the during the multi-cap fund new fund offer.
So SEBI had undertaken this recategorization exercise, and then a lot of funds were Flexicap. Then they moved to the multi-cap category, and later, I think, on the request of the industry, the SEBI once again introduced the Flexicap category. Could you, for the benefit of our viewers, could you take us through what had happened at that point of time?
Basically, rather than telling you the history, let me tell you where these two categories fit in the context of investors. And I would say that both of them have their place in investors' portfolio. Now, if you look at a Flexicap fund, generally Flexicap funds tend to be more large cap buyers. That is more got to do with the construct of the benchmark that most of the funds are benchmarked to, which is a SEBI-prescribed benchmark of NSE 500. And that has a composition of 76% large cap and 24% mid and small cap. So most of the funds who are sort of looking to beat this benchmark tend to be large cap heavy in that context. The multi-cap benchmark, on the other hand, comprises of 50% large cap 25% mid cap, and 25% small cap. So it's more evenly distributed. So for a person who wants to operate slightly higher in the risk spectrum, I would say that the multi-cap fund kind of suits his or her palette better than the flexi-cap fund, both in the context of a balanced portfolio across large, mid, and small cap stocks on net balance. So on net balance, I would say that both are suited for a purpose. Both are mainstream categories. The flexi-cap fund would be probably for a more conservative investor, whereas the multi-cap fund would be a slightly more aggressive investor who doesn't want to leave the safety cushion of the large cap, but does want to participate in the upside that mid and small caps bring to the table.
So the mid and small cap category has already rallied a fair bit. Does that create issues at this point of time when you're launching a fund which will have at least 50% allocation to mid and small cap funds, stocks?
So, in fact, I would say that in the current circumstances, where a lot of money has been made in mid and small cap funds, incremental money, which is looking to get into mid and small cap, we would argue that that should probably get today into a little more balanced portfolio, which is the multi-cap construct. And the reason why we say so is because if you look at the mid and small cap as a space, it is slightly lower in terms of liquidity in the average, and hence there are pockets of irrational exuberance which we see within the mid and small cap universe. Now, that is not to say that mid and small caps are not investable, but in certain pockets we are seeing a bit of over enthusiasm. Now, what we are looking to do in the context of a multi-cap portfolio is that, replace those overvalued mid and small caps, or think of them as a replacement of those overvalued mid and small caps by the large cap stocks where the risk-reward balance is more favorable. So hence, I would say that a balanced portfolio like a multi-cap fund is just what the doctor ordered for the current market conditions. Given that mid and small caps have rallied quite a bit, we need to be a little more selective in the stock picking within mid and small cap domain, and hence the large cap component.
Now, one concern about the multi-cap category is that if there is a prolonged downturn in mid and small cap funds, or in the market in general, where the mid and small cap stocks tend to fall more, then this category could be problematic for retail investors. What would you say to that concern?
I would say, first of all, that given that the component of mid and small caps are higher in a multi-cap portfolio versus, let's say, a flexi-cap portfolio, just as a matter of comparison, yes, if there is a prolonged downturn and the mid and small caps tend to fall more, it will impact this portfolio, a multi-cap portfolio, more than a flexi-cap portfolio or a large-cap oriented portfolio. And hence, as I explained earlier, a multi-cap fund is probably slightly higher in the risk spectrum as compared to that of a flexi-cap fund or a large-cap oriented fund. However, if we look at the data which presents, how the returns have panned out over the last 3 to 5 years per unit of risk, then we also note that the return per unit of risk for multi-cap category is higher than a mid or a small cap category. So on net balance, what we are looking at is that it presents a better risk reward equation versus certain categories, and hence it has a certain pace in the asset allocation. It is not sort of downfall resistant, but to a certain extent cushions the fall versus a mid or small cap portfolio.
Given that this category could have higher risks, what are some of the precautions that an investor getting into this category should take? Would you have some advice for retail investors?
I think the first and foremost thing that I would say is have a longer term time horizon. When I say longer term time horizon, particularly when you are looking to invest in equity funds and particularly multi-cap funds, which have a meaningful component of mid and small caps, I would recommend an investment outlook of 5 to 10 years. I think over that time frame, the time arbitrage works out in favor of good business models, and investors who have held on for that long have made meaningful amount of money in the past, and I'm confident that they will continue to do so in future as well. If they dabble in and out too many times in the short term, that could be kind of, that could be a death knell, because they would get whipsawed by the volatility that they might find in the equity markets. Second, I would say that if investors are jittery about getting into markets in one go in lump sum, I think one of the suggestions that we are also making is to use the STP mode to gradually enter into the fund over the next 6 months or so. We think this is a good way to navigate through the current short-term volatility and yet participate in the medium-term upturn for Indian stocks in general, also the mid and small cap.
So there are already a number of funds in the multi-cap category. How will you differentiate yourself? And your presentation also spoke about the fair approach to investment. What is this approach? Could you tell our viewers about that?
Sure. So as we started our conversation saying that macro is looking decidedly negative, we plan to run our multi-cap fund in a differentiated way by focusing on pockets of earnings resilience on a bottom-up basis. In our opinion, there are 5 pockets of earnings resilience where we plan to populate about 70 to 75% of our multi-cap fund. These 5 areas are: first, we are looking to sort of go overweight the capex as a theme, because we think there is a good chance of a manufacturing upcycle driven by private sector capex over the next 3 to 5 years. Second, over the next 1 year, we think lending financials, which is banks and NBFCs, are in a good spot, and hence their earnings are likely to be relatively resilient over the next 1 year or so. And we plan to kind of be overweight the lending financials part of overall financials as a space. Third, we think real estate is in the middle of a 5 to 7 year upcycle, where in the first 2 to 3 years, the inventories are bottomed out and launches are just about happening. We think that there is still some more room to go. So as direct and indirect plays on real estate, we look at it as another area of earnings resilience. Fourth, we think indigenization of defense is another decadal theme which Indian companies would benefit disproportionately, and we think an area where earnings are likely to remain strong. And finally, as part of China Plus One, we think electronic manufacturing systems is a space where we see the sector growing at about 30%, and companies could grow even faster depending on if we do a good job at stock picking. So net balance, we see these 5 areas as pockets of earnings resilience where we plan to be overweight. That's not to say that there are not other areas that we will not invest. About 70 to 75% would be in these areas, and the other areas we will be more selective in terms of stock picking. We think in running in a differentiated bottom-up way, we can have a good portfolio which is oriented towards wealth creation for investors over time. Finally, I think while picking stocks on a bottom-up basis, following the themes is one part of organizing a portfolio. We think the investment philosophy or the investment process is another aspect which we follow very diligently. And as part of our investment process, which you highlighted as fair, there are 4 cardinal principles which we follow. First, forensics. Second, acceptable price. I stands for investment style agnostic between value and growth. And finally, R stands for robustness. So these 4 words form FAIR as an acronym. But if I were to sort of summarize in a nutshell what this investment philosophy and process is all about, I would say that we at Edelweiss MF, we are bottom-up investors. We are interested in financially clean companies that can grow not only in terms of high growth rates, but also have better profitability and return ratios. We are ambivalent between value and growth as a philosophy, and we believe value and growth joined at the hip. And finally, the stocks that we pick should have a meaningful upside to the intrinsic value, which we quantify as 20% or more. So we think that following this philosophy, a simple philosophy and process in a nutshell, and orienting the portfolio around the themes that I highlighted is an ideal concoction for wealth creation for investors over time.
And your presentation also mentioned STEP. Could you explain for our viewers what the STEP facility refers to?
Yeah. So that was just to draw the context of the earlier answer, which I was giving to your question, that what are the two things investors can do to minimize the downside risk if there is the risk of correction in the near term or the risk of volatility in the near term. One of that is the step function that we talk about. In a sense, in a nutshell, I would say that what we have come up with the facility is that over the next 6 months, the money of the investor can get gradually invested in the multi-cap fund over a period of 6 months, particularly in tranches on a monthly basis. That's one. Secondly, every time the NAV falls by 3%, incremental money gets plugged in to the fund. So overall, it's a step way of investing, wherein if there is a downward tick in the markets, money gets incrementally pulled in. And if market remains flat to up, then over a 6-month time frame, it acts as just as an STP. So in many ways, it's a smart STP, if you can think about it that way. Which brings in a feature that the investment kind of is done consciously when the market falls with every market fall of about 3%. So I think I have been able to explain this at a very 30,000 feet level. Investors are well advised to speak to their advisors to understand what this is in more detail and then invest. But in essence, this gives a way to investors to invest in a gradual manner over the next 6 months, which might work out, which might soothe investors' nerves and also get them navigate through the near-term volatility.
Thank you, Mr. Bhattacharya, for explaining the nuances of how your new fund will operate, and good luck with the new fund. Thank you.
Thank you, Sanjay sir. Thanks for having me on your show.
Goodbye.